Debt is a common financial tool that, when used wisely, can help achieve important life goals like education, home ownership, or building credit. However, debt can also become a burden if mismanaged. There are multiple types of debt. Let's review a few of the most common scenarios. First, let's talk about student loans. They're designed to help cover the cost of higher education, and they typically have lower interest rates than other types of debt. Federal loans often have fixed interest rates and flexible repayment options, including income-driven plans. Private loans may have variable rates and less flexibility. If you have student loans, you should pay attention to grace periods and avoid defaulting. Student loan debt can be challenging to discharge, even if you declare bankruptcy. Mortgages are long-term loans for purchasing a home, and they are secured by the property itself. Fixed-rate mortgages offer stable payments, while adjustable-rate mortgages, also known as ARMs, may have lower initial rates that fluctuate over time. Mortgage terms typically range from 15 to 30 years. When considering taking out a mortgage, you should aim to keep housing costs, mortgage, taxes, and insurance below 28% of your gross monthly income. Credit cards are a form of revolving debt that allows you to borrow to a set limit, often at higher interest rates. Minimum monthly payments are required, but carrying a balance on your card leads to interest charges. Many credit cards offer rewards or cash back, but these benefits are outweighed by high interest charges if you don't pay in full. You should use credit cards as a tool to build credit, not as a source of long-term borrowing. Now let's go into understanding interest rates and the cost of borrowing. Borrowing money comes with a cost, that cost being interest. Interest is the cost of borrowing money expressed as a percentage of the loan amount. There are two types of interest rates: fixed interest rates, which remain constant over the life of the loan, and then variable interest rates, which fluctuate based on market conditions, often leading to uncertainty in payments. Annual percentage rates, or APR, combine the interest rate and fees to reflect true costs of borrowing. When shopping for loans or credit cards, you should be sure to compare APRs. So why do interest rates matter? Higher interest rates mean higher monthly payments and more money paid over the life of the loan. Not to mention, if you only pay the minimum on high interest debt like credit cards, this can result in paying much more than you originally borrowed. Now in part 3, we're going to look at strategies to pay off debt faster. There are a few strategies to consider. The first being create a budget. Allocate a specific portion of your income towards debt repayment. Use tools like the 50-30-20 rule to balance expenses and savings while focusing on debt reduction. This method is 50% of your income goes towards necessities like food, rent, and utilities. 30% of your income goes towards discretionary spending like entertainment, travel, and hobbies. And 20% of your income goes towards saving and debt repayment. Next, you want to prioritize high interest debt. Focus on paying off debt with the highest interest rates first to save money over time. This is also known as the avalanche method. Instead of the avalanche approach, you can take the snowball method approach and pay off smaller debts first for psychological wins and momentum, and then apply those payments towards larger debts. You can also make extra payments. Add extra money to your payments each month or make bi-weekly payments to reduce the principal faster and save on interest. Then there's debt consolidation. You can combine multiple debts into one loan with a lower interest rate or a single monthly payment. Consider this for managing high interest credit card balances. You're also going to want to negotiate rates and terms. Contact creditors to request lower interest rates or revised payment plans, especially if your credit score has improved. Lastly, we'll cover tips for staying out of debt. First, you're going to want to live within your means. Avoid taking unnecessary debt. Save for discretionary purchases instead of using credit. It's also extremely important to build an emergency fund. Set aside 3 to 6 months of living expenses to avoid relying on credit during financial emergencies. You will also want to avoid high-interest loans. Steer clear of payday loans or other forms of predatory lending with unreasonably high interest rates. Finally, you want to use credit wisely. Pay off credit card balances in full each month to avoid interest, and use rewards responsibly to maximize benefits. Debt can be a valuable tool, but only while managing it responsibly. By understanding the types of debt, the true costs of borrowing, and effective repayment strategies, you can reduce financial stress and regain control of your finances. If you'd like to learn more about saving for your retirement, just click the card on the screen.